What's up, Bat Fam? Welcome back to the Build a Trader YouTube channel. In this video, I'm going to be talking about risk management. If you don't know what risk management is, or if you don't have a risk management strategy, or if you don't know how to implement risk management into your position sizing, watch the end of this video. I got you guys. You're going to learn a lot. In the trading industry, you hear a lot of these people, a lot of the professionals who have been in the game for a long time, like decades or more, always referring back to two key concepts or things that contributed to their long-term success, and that is discipline and risk management. You always hear risk management being thrown around. Manage your risk management is super important, this and that, but what does it actually mean, and how do you actually manage your risk when it comes to trading? How do you consistently manage your risk? Well, first, let's start with what the definition, well, to me at least, what risk management means, as well as some different terminologies that come with it. There's one, your typical risk management, where you place your entry, you get in the trade, you place your target, you place your stop loss below whatever point you set, and then let the trade play out. It also refers to risking only a certain amount of capital, or cutting your losses, or refers to not over leveraging or using correct position sizing so that you don't have too much drawdown and as a result risk too much on one particular trade and have a large loss. And by large loss, I mean an unreasonably large loss, not just an extra percent or two. It's like a major rip. There's also another term referring to risk management called dynamic risk management, and this refers to cutting your losses early or using your understanding of candlestick analysis and price action to understand when a trade that you've entered is not working early on. You can actually manage your risk earlier because you understand it's not working. You're more dynamic, you're more fluid, you're not so rigid in your stop loss to where you're like, I accept this risk, I'm getting stopped out at this point no matter what, even though I see I'm wrong. I personally believe integrating both of these two types of risk management into your trading is very beneficial and crucial. As the market is constantly moving and it's very dynamic, you have to adapt in certain ways, and sometimes setups that you see that are continuations end up breaking back in and faking out, creating a wick. So at that moment, you may have been right in terms of the direction of the trade, but the market switched its bias. So understanding that and reading this stuff early on, using candlestick analysis, you're able to adapt very quickly, manage your risk or manage your trade a lot more efficiently. Alright, so I've talked enough about what risk management is. It's easier to show you what it is and give you guys a risk management plan and strategy and show you my own examples and how I have managed my own trades past, as well as manage my own risk. That being said, I'm gonna head the charts. I'll see you guys there. Alright, Bat Fam, I have typed up a risk management strategy for you guys. Take a screenshot of this. This is exactly what this video is going to build on top of. For position sizing, learning how to scale in, which I won't go too much into, that will be a whole separate video. But learning how to scale in, learning how to manage your risk dynamically, learning how to get additional entries on trades to get up to your max exposure. I'm going to show you that all, but take a screenshot of this. This is very important. On the left side is for more retail accounts. I know a lot of you guys are out here just putting in $100 into an account, or $500 up to maybe even 5K. Some of you guys got that laying around and want to start trading. Follow this list, okay? Let me explain what this means. On a $500 account, a lot of you guys probably have $500, and a lot of you open a $500 account. I know I opened a lot of $500 accounts when I first started. The max exposure you want on a $500 account, on a margin account, is going to be a 0.1 lot, which is equal to $1 per pip, okay? $1 per tick on the foreign exchange market. And so the way you get into that 0.1 lot, that $1 per pip, is a variety of different ways, because as a new trader, you have to learn how to manage multiple different positions, okay? At first, opening one position is gonna be enough. Then two is good, but getting up past that, you don't want to have too many open positions. So 3, 4 is good, 5 maximum. That's why I made it max 5 positions. And this strategy right here, what I'm showing you, is exactly how I have passed multiple funded accounts. Although I've lost many, I've even made a video on how I lost my 50K account, even though it was in profit. I can put a little card up if you guys haven't seen that yet. Following this exact strategy right here is what made me a lot of money in my trading, and has also lost me a lot of money by not doing it properly, by overexposing, by not sticking to proper risk management, by doing way more than this, way too much, going deep. you're gonna see a lot of professionals out here scaling in. You're gonna see a lot of stacked orders. What this is right here is not the same as that. These are calculated risk exposures based off your capital and account size and your risk percentage per trade. It's not just scaling in rapidly, doing a bunch of buys or sells. This process is a lot more calculated and disciplined. These professionals that you see scaling in with a lot of lots and are super deep with a lot, like 10, 20, 30 positions open in the market, is because they're professionals. They can manage that risk really quickly. They can close those positions and stuff without hesitation or fear or greed, because they're professionals. A lot of these guys you're gonna see out here, like Q Banks, who else? James Storms. A lot of these people scale in and make a lot of money, and they take advantage of these market movements that they're in that are going in their favor. But you cannot get to that point until you understand the rules. And once you understand the rules very, very well, then you can break the rules. But until you get to that point, you got to follow the rules. So follow this. Back to what I was saying. So the max positions you want is 5, and if you do the math, 5.02 lots is equal to 1.1 lot, okay? 0.1 lot. You can do a different variety of math to get up to that point. You can do 2.0.5 lots if you want, depending on the trade. It just depends what you see. But the maximum you want is 5 positions, and the most you want of a position, the most you can put on any trade is a 0.1, okay? Nothing more than that. Otherwise, you're really gonna hurt yourself, and you really shouldn't just be dropping your max exposure on these trades, right? On most of these trades, that's why it's spaced out like this with inter-max positions. You can manage your risk very quickly if you just put a little bit on. So say you're risking, and I'm gonna go over a lot of examples of this on the chart. So I know it just sounds like I'm talking a lot, but this is the whole idea of everything. So say you're risking 1%. You always hear risk 1% per trade, risk 1% a trade. Yes, you can do that. However, what if that trade didn't work and you get stopped out right away? That's your 1% for the day? No, a lot of times the market will push in your direction, then the bias will change, then you might get stopped out, or you manage your risk early, then you can quickly adapt and catch the direction that the market is actually moving in now, or in that current time. So with that being said, having these multiple positions, starting off small and then building up on a trade that is pushing in your favor and actually working, allows you to reduce your overall risk, okay? So for example, let's say you're risking 20 pips, okay, on, let's just do it like this. Let's say on a $10,000 account, the max you want to lose is 1%, so $100. If you put on a 1 lot and you're risking 20 pips, you're gonna lose 2%, so you can't do 1 lot, right? So you're gonna have to put a half lot, a 0.50 lot, a 0.50 lot, and 20 pips equal to 1%, okay? However, what if you split that down into a 0.25 lot and you get in there first, okay? And you still have 20 pips, instead you're risking 0.5%. And now as the trade's going, if you get stopped out, you risk less overall. You risk 0.5% instead of your original 1%, which gives you another chance, another opportunity for a trade, right? Or say you get in with 1 entry and it's still within the price range of your trade without it being invalidated, without structure breaking or anything like that, you can get an additional entry at a better price. Okay, so for example, say that 20 pip stop loss example I was just saying, you can't put on a half lot, or you can put on a half lot total, but instead of losing exactly $100, you might end up losing just $75 instead. Even though you still got to that max exposure that you wanted, you end up losing less simply because you didn't jump all in with that full lot size. You waited for a slightly better price, or you scaled in when it was going in your direction. So now you're in profit, and it's more of a better timed trade. You entered on a winning trade, you added to your winners, and that's what they always say, cut your losers quick and add to your winners. So this is how you add to your winning trades without overexposing yourself too much, without over risking. You stay calculated within your max exposure, within your risk parameters for your account size, and then you add to your winners accordingly using your max position sizes that you can use and your max risk exposure. Okay, so let's go over some examples. Don't forget to take a screenshot of this. I'm gonna have to move this out the way. All right, so let me give you an example. I know this sounds like a lot. Okay, We're gonna go over a trade that I called last week, these USDJPY sells right here, where this box is on this wick, okay? Now it didn't go to TP because I was targeting these lows down here, which may happen later this week. Watch the weekly analysis video if you want to find out what I'm thinking and what I see. However, for this though, I was targeting here, these lows, ended up only hitting right here, right? So for example, let's say you have a $10,000 account. Let me type this up. Actually, no, I'm doing this for you smaller retail guys. $500 account. The max you can have is a 0.1, right? So most positions you can have is 5 0.2s, 0.02 lot positions. So some of you may already be like, wow, that's way too much, because a 0.1 within 5 pips, that's already 1%. I know that, so watch this. So for example, I'm gonna go down to the lower time frame where that zone is. Pretend I just took that trade like I did last week. I'm gonna go over this exact process. I personally scaled in with 2 positions of 0.25s, okay? Using this exact process, but this is how you do it. So I believe I entered this trade at like 5-0 and a 4-5, 4-5-0 and 5-0. Or around this price range, these price ranges, okay? So you see how I have these risk to reward tools up. When you first see a trade, now necessarily, I didn't enter over here, I entered before it dropped. So I'm gonna move these over. Entered on when it was bullish, so I had some drawdown, and then it ended up moving, ended up going down. And so this is how you do a scale-in method. Like a normal trade, you could just enter right here with your full risk that you would normally do. You know, your 1% risk. So in this position, let's see, you'd be risking 25 pips, okay? So for you to have a 25 pip stop loss, risking only 1% on a $500 account. Now this is all just theoretical. I think you should be risking more than 1% on a $500 account. You know, you're trying to grow this thing. In theory, let's just say 1%. 25 pips is $2.50. So you could use a 0.02. A 0.02, 1.02, 20 pips, that would get you $5, basically a $5 loss, slightly over, but basically a $5 loss, 1% loss. So you enter there, and then you just trust the process, let it hit. Or you could have entered smaller position, then as it's going in your favor, you know, you had the drawdown, you survived. Or you could have entered at a better price. You're like, okay, risking $2.50, I know I can get, I don't want to put my full risk exposure on yet, so I'm going to try to catch this wick. So you do. But either way, if you get stopped out, you end up losing a little bit less than you would have. You would be losing less than 1% still. You would have a better price here and a better price there, that price there and a better price here, and the average would be less than 1%. With that being said though, so say you got the wick, it pushes in your favor, you're already at the risk that you wanted. This level breaks, and now you can enter another position, because this is where it gets calculated. You're not overdoing it, but you're able to scale in with more and maximize your trade. So you see the wick, you're able to enter again. Now this is how you understand lower time frames. You understand, okay, the support broke, I see the wick, I'm getting in on the momentum, boom. As you're doing this, as the market's moving, you're moving your stop loss to boom, break even. This one's break even now. It's already pushing in your favor. You see it dropping. You just entered this trade. This stop loss needs to go either to where this break even point is or this one. That depends on you. But to be safe, you would want it probably at this break even point. So no matter what, you'd be able to make some money still if you drag this position, or this stop loss down to here, as such, down to this position. You'd still make some money. If anything went crazy, you got stopped out, so say if this is a break, it just went bam. You'd still make some money, and you'd be able to trade another day and figure out what the next move is or what's going on. But in this situation, when in our favor, it dropped, you're able to scale in and take advantage of the move and get your full risk exposure on, okay? That's one way. So that's how you're able to scale in, and I'm gonna have some pictures pop up right now that can show you an example. This was my biggest trade I've ever had. I made, I was up with $6,000 on XRP USD on these buys earlier back in September or October, I believe it was, and I ended up only closing for $3,000, but that was the biggest trade that I had. And you can see I have multiple scaled in buy positions, although like I said, I was overexposed. I didn't follow that plan. Like I just showed you guys, I did way more than I should have. And that's what ultimately caused my downfall a few months later. But regardless of that, if you scale in properly, as you can see, all those multiple scaled up positions, if you do it properly, you can take advantage of your trade. And overdoing it is how the professionals, how it looks. That's what the professionals are doing, but they can do that because they have hundreds of thousands to millions of dollars of capital. So, you know, really, they can afford to do it. Us retail traders, we cannot afford to do that. And especially if you're a funded trader like myself, we cannot afford to do that. That's just, we can't until we make it to the big leagues. But even then, you know, our risk management stuff and trading style will be so different that I don't even think I will be even trading that way again. But we'll see, who knows. But regardless of that, here's the loss that we took. And here's a way to manage risk effectively, like I was saying. So using that position sizing chart, that list that I have, you're going to base those calculations off your total risk for your trades and your capital. You need to do that every single time. That was just a rough little guide for you, but base your calculations off the max exposure limit that I said. And don't just drop all in on it unless that's what you're truly accepting. But you need to have a stop loss. You shouldn't be blowing your accounts. You know, there shouldn't be such a rush to make all this money when you never really even had it in the first place. And if you take your time and learn, like actually learn this stuff and learn risk management very, very well, you're gonna get a lot further ahead than everyone else, because everyone else trying to learn how to trade is trying to make money right away, and they're over leveraging, and they're seeing people scale in like crazy. Like the example I just showed, they want to make thousands of dollars and this and that, and that's how you keep blowing your accounts and doing dumb stuff. But if you do calculated and follow the plan that I just showed and learn how to do this properly, learn how to read the candlesticks, learn how to read structure and time frame correlation, you can get really far. Okay, but here's the loss that I took, and this is how you can manage your risk dynamically or adapt to what's happening in the market. I was seeing this trend line here. I don't even really use trend lines, but the market was in an uptrend, so that's what I'm using it to illustrate. And there was a level of resistance here that the market failed, or the market that I thought broke above, but it failed to break above overall, right? So I saw this, I had it like this as such. I was like, oh, we just closed over. Boom, this is totally a buy. So what I took buys, and I was targeting like 129, I believe. Because I was like, okay, break up 128.650 is gonna initiate a breakout. And it did later on that day, later that morning, as you can see right here. But in this moment in time, it dropped, retested and dropped again. So essentially though, how this played out right here. So as you can see in this uptrend, it's making higher highs and higher lows. Well, the trend changed when this lower high formed, right? It was a fake out. If the market was going to continue higher, and this is why you need to have a really strong understanding of candlestick analysis and be back testing, you know, at the very least, like 15 minutes a day. Everyone's got 15 minutes just to hop on the charts and look to see what happened. All right. But, you know, half an hour a day, you're gonna learn a lot. You know, that time adds up and your eyes become trained to the price action. But as such, as I was saying, the price needed to break above this high here, and it would have continued higher. The fact that it didn't means that it failed, it rejected, it's going to go lower. So seeing that, I had, let's see, this was the position that I had. I believe I entered right 600, yeah, something like that. And I was targeting like this, 129. And this is a good trade. Like, if you really look at it, in theory, it should have worked out. It did work out over here, but just in this moment in time and the time frame that it was in, a lot of stuff needed to happen first, and it did not work out. Okay, but here's how you can understand things. So you're on the lower time, I'm on the lower time frame, the 5 minute. You can see in theory, this is what I saw, these bullish candle patterns. I was like, yes, it's going up. So it did push in my favor about 7 pips max, I think. And here's where I could have personally managed this earlier using dynamic risk management, but I had my stop loss below the point. And I did close a little bit earlier than that, but it ultimately did just fall to the stop loss. So I didn't really save myself that much money. But if you recognize the stuff early on, as I'm trying to show you, as you can see, this little level right here broke. This needed to be the point that the market continued higher from, where the zone is, where this line I'm drawing now. So it needed to push off, It tried but failed. It broke lower. The fact that it didn't is your indication that, okay, it's not going to work. And then your next clue, once the price closed bearish and broke below this little point, that's your clue, like, all right, we need to get out. So really, instead of getting stopped out down here or closing down here, I closed it like 3-0, so 5 pips before my stop loss. It was down here, closed like right here. But had I been more attentive and had I been actually sitting down and looking at the charts, I could have been like, okay, yeah, this just broke. Let's just cut it. Let's just cut it. Just close. Because it shouldn't be doing that, right? If it's an uptrend, it would be higher highs and higher lows. The fact that it didn't is why you got to be dynamic and cut your risk. And let's say in this situation, you were in your max exposure already because you saw this going. You're like, okay, caught the wick. This is all theoretical. Okay, but let's just say you got injured half your position. You're like, boom, okay, the stop loss is down there. You're like, no matter what, I'll lose 5 or my 1%. Or if you did half that, you're like, all right, I'll lose 0.5% if the stop loss hits, but if I can get another good entry, then I'll end up losing max 1%. But if it pushes in my favor, then you'll make, 3-1, or, whatever it is the risk reward is. So that's pushing up, you move your stop loss up, so your exposure's less and you end up losing less, and then boom, it fails. So you get stopped out, you lose less, and you still had more risk on. That's the whole point. If you can risk more while losing less, that's amazing. That's the whole point of the game. And I'm not just making this stuff up. There's lots of mentors out there that are actually showing this. People like Raha Banks. If you guys don't know who Raha Banks is, you guys should look him up. He's got a free YouTube channel, and I think his program's called like Market Fluidity or something like that. But very helpful stuff. I learned a lot about risk management from this guy. Very, very smart. And who else? Rocks Effects talks about risk management stuff a lot the same exact way. All right, this is how you really trade and really trade the markets. You can definitely jump in with high lots, but that could really hurt you depending where you get in, depending on your understanding of the market. So you really shouldn't be using high lots right away when you're first starting. You need to learn how to scale in with your max risk exposure with the process that I just showed you, with the guide that I just typed out for you guys. Using that process, whether you're trying to pass a funded challenge or become a funded trader, or if you are a funded trader, or if you're just a retail trader just trying to learn how to do this, if you follow that guide and don't overexpose yourself, you're going to learn how to be in the game longer and learn how to manage your risk. All right, because look, you might have, your wins are going to be, I'm just going to draw a random line. This is how your progress is going to look. You might have some wins, you're going to have some losses, you might have some wins, it might be like this, and you might have a good trade. It's just going to be all over the place, and you'll be like, why? It's going to be like this because you don't know your risk management. Now, after you start implementing risk management, you start looking like this. It might not be all over the place, it might be more like this. Consolidating sideways, but what's going on? This is more consistent. This isn't all crazy and stuff. You're staying in the game here. So you go from this stage, all wild and stuff, flipping accounts. Like I've said many times, I flipped $500 to 10K 3 different times, but I also blew up the next week each time. Because why? Because of poor risk management, poor discipline, scaling it, over risking, all that type of stuff. But if you stay disciplined and follow this process, you can really build up your account quickly without over risking and over exposing yourself and managing risk efficiently. So once you start getting to this point here, okay, you eventually will start seeing your progress like this. Not in a solid uptrend, but the trend will be up. That's what you want to see, right? An uptrend in your profits, an uptrend in your equity curve. This is what you want to see. This is totally fine. There are going to be drawdown periods. There might be multiple drawdown periods. There might be a point where you come back down to here and it gets a little ridiculous. Then you come back, and then you might come back to this point and then make a little back, then come back down, then you finally make even more. This game is an up and down ride. It's a roller coaster. And if you know how to manage your risk, manage your emotions, and consistently manage your risk and not overexpose yourself and stay disciplined, you'll go from this ridiculous equity curve to here, and it's not going to be an overnight process, but you have to learn all this stuff you got to put in the chart time. You have to learn how to scale in effectively by using the lower time frames for entry points and correlating your higher time frames with the overall move that the market is going in. And by doing that systematically, consistently, you're able to maximize your trades, maximize the movements, and you're able to consistently grow your account without taking too many big hits. Sometimes when you do this, you're gonna take a calculated hit, or it might be a little bit bigger. Okay, but as long as you do not overexpose yourself to the degree where you blow an account, as long as it stays in a reasonable loss, you're gonna be able to do this. And every professional that I've learned from and still learn from, they all say this. You know, my very first mentor who put me on to Q-Banks was the very first, or Wall Street Academy was the very first course I learned from, and that's the foundation of my education still. Wall Street Academy is the best thing I've ever learned from in these past 4.5 years. You know, it's been my foundation. However, my very first mentor, Mar, I think he's a 7 or 8 figure day trader now, you know, big boy making mills. But what he told me was, I can lose 4 trades in a row and still be profitable because of good risk management and risk reward ratio trades. And I didn't understand that entirely. I was like, oh, okay, yeah, cool. But when you take 4 losses in a row, which I don't know if you guys have, what happens? You get messed up psychologically, or you can get messed up psychologically. You'll lose your confidence. You'll feel a little down. You'll have doubt. You'll have doubt in your trading system. It might cause you to over risk the next trade, and all of a sudden you lose your funded account, or you blow your account, whatever it is. So if you're confident in your trading system, you're confident in the risk reward trades you're taking, if you can manage your risk effectively and learn how to control these losses and learn how to scale in and out effectively and take advantage of moves working in your favor, your equity curve is going to start going up. But until you really triple down on risk management, your consistency will be non-existent. You're not going to start making profits right away once you start managing your risk, but you'll end up losing less. The swings in your equity curve are going to be a lot less. You're going to be in the game a lot longer, and that's how you're going to learn. That's how you learn to build on your foundation and on your discipline and on your trading plan. And that's how you learn how to manage your trades more effectively. I will also make a video on trade management and more in depth on scaling in. But I really just wanted to talk about risk management and show you guys that risk management plan more than anything. So I hope you guys learned a lot from this video. I know that if I watched something like this when I first started, it would have helped me a lot. Don't forget to subscribe and like this video. Don't forget to follow Bat Signals, Build a Trader on Instagram. And don't forget to join the free Telegram channel in the description. Free Discord as well. See you guys in the next one. Peace.